direct sales are slightly more complicated than just wholesale. And this is a very useful exercise for us to think about slightly more complicated channels of selling, is that there's going to be a markup on everything which is sold through direct sales. So what I mean by this is that the same shoe, which is perhaps sold in direct, costs more and brings in more revenue for Nike than if the same shoe was sold through a wholesale channel. And this markup, which we have assumed for the past years, is around 55%. How we come up with this number? Why is it 55 and not like 54? That is something like I can't really answer to you. But what I can tell you is that why it's 55 and not 75, for example, is based on steady analysis of the kinds of margins which Nike has by looking at industry competition as a whole and how other competitors in the industry are marking up their products. And that's why we think that 55 is a very reasonable number. What you'll note is that often what happens in modeling is that it's a series of assumptions. And while this may sound slightly counterintuitive at the start, it'll start to make more sense to do it more, is that the more assumptions you make, the stronger your thesis becomes because you're breaking down things to granular levels. So you want to be as detailed as possible when you build a model in terms of your revenue drivers, in terms of the granularity to which you go to. But at the same time, it's important to balance this with a sense of realism, right? You do not want to be too granular to the sense that you're literally forecasting every small expense along the way, every small revenue driver along the way. So you want to find a balance between being granular and being as detailed as possible and being realistic and ensuring that your model doesn't run into like 10 pages of 300 rows per sheet. So now we're going to assume, for some qualitative reasons, perhaps by looking at earnings calls, perhaps by looking at what the CEO says on Nike, that eventually what we think is happening is that these markups are going to increase, perhaps because they think that they have a strong industry presence and they think that they can price their goods at a premium compared to some of their competitors or what they were doing before. So again, now your direct sales revenue figures are going to change because of your assumed markup and your assumed volume. And the formula for this is rather simple, right? So what you do is you take G10, which is, scroll up here, just your total North American volume sales. You multiply that by the percentage to find out how much of that is coming from direct sales. And then you multiply that by a 1 plus 60%, because that's the markup and that's the sales you get out of each single shoe you sell through direct sales. So again, we're just going to get these values in, sum it all up. The sum is a rather straightforward function. So you just do sum and then you take all the different values. So normally you can just do a sum like G151 colon G162. But here in this case, you can't really do that because there are percentages in between. So you do not want to be treating the percentage values as numerical values. So it doesn't need to look out for as well. But overall, what you eventually get is the sum of all these things. Another good practice to have usually is to comment assumptions. So for example, if I had an assumption, which one of the first ones I started out with, that I think volume growth is going to be 15% per year in China, for someone who's reading just your model, perhaps, and so often what happens in stock pitches is that perhaps the person reading the model is a slightly different person from the person reading the thesis, or that perhaps he's doing it at a different time, right? So you want to have some kind of like a refresher as to why your thesis argued that it's going to be 15%. So a very useful thing we all like to do is we just insert comments, right? So you just come to insert comment, and then you just type something like from thesis about Chinese market. And that's just going to be there for you next time when you refer it back to the model. So scrolling down, eventually once we broke down the channels into wholesale sales and Nike direct sales, you then can just sum all of these values because Nike direct sales plus country wholesale sales should give you North American geographical revenue as a whole. That is just a simple sum. And obviously the growth formula is the same as before. So you just take this value and you divide that by that, and then you minus 1. So, but the thing is, often what happens in these kind of big companies is that while your geographical revenues and your main sales model, which is your wholesale and direct channels, maybe pretty much 98% of revenues, there's often a small 2% or 3%, which just comes from slightly inexplicable like things, right? Or slightly things which are very hard to exactly pinpoint. So that often happens, and that's something you should be very much prepared for. So similarly for Nike, beyond just the first 4 regions, they also have some things called global brands. And they have some things called Converse, which is another brand they own, which they choose to segment their reporting for, so they keep it separate. And you should probably follow the structure used in their 10K. And corporate earnings, whatever that means, right? So what is a useful practice is that if you do not have any strong opinion about any of these things, if you don't really know whether or not corporate earnings are going to change over the next 5 years and you don't really have any good reason to, it is useful to flatline these things. So what I mean by flatline is you just assume that growth is going to be broadly stagnant or zero. And that just means that you're not going to expect anything from this to really change what happens in your model. Of course, here there is one useful thing to note is that it's good to be always to err on the side of caution. So what I mean by this is that if you are pitching a long on Nike, for example, and there are parts of the revenue drivers which you just don't know are going to change a lot, it's always better to put them at zero or put them at even negative, for example, and to be slightly bearish, because you do not want to have things which are directly and very much in a huge way impacting your final stock price coming from drivers which you don't have any real idea about, like corporate earnings or how much you think global brands are going to grow by, which is why it's always useful to keep it as bearish as possible if you're pitching a long, and obviously if you're pitching a short, it goes the other way. So now again, we're just going to fill in these values again. How we get these values is just the same as always. So you take the previous year's value, 1 plus the growth percentage to come up with this. Sometimes you'll know that the growth percentage is derived from the value, and sometimes the growth percentage is what is used to find the actual numerical value. Both approaches work and are often interchangeable. So eventually you're done with all of this, and you have your final revenue figures. This is very important because your total revenue, this bottom line here, is what feeds in to the top line of your income statement revenues. And that's how, I guess, your revenue drivers really feed back into the whole company's financial statements, into your valuation as a whole, because the final bottom line and how you broke up revenue into so many different things is very useful. And I guess that's why it's important, right? Because if you just looked at Nike as a whole and you said, and you just eyeballed, I think it's going to grow by 8.9% next year, it's going to grow by 10% next year, you don't really have as much of a reason. But if you broke it down all the way to per region sales, to per channel sales within a region, and then you give a lot more structured reasons along the way, that builds in comprehensiveness to your model and makes your investment thesis slightly stronger. So that is that for the revenue drivers, right? And there are a few more types of drivers, 3 more to be precise, which we're going to go through. The next one is working capital drivers. So working capital drivers are slightly unique in the sense that they are built not exactly the same way as a revenue driver, where you literally broke it down into every single component of revenue. Of course, you could if you wanted to go into greater detail for working capital as well, but for the sake of simplicity, to keep this thing simple and understandable, we're not going to do that. So here for accounts receivable, what we first do is, so we know these numbers from financial statements of past years, right? As you can see from the cell reference, they all come from financial statements. These are numbers which are pulled from there. What we then calculate is something called accounts receivable days. This is a concept where it basically, this number 36.6 implies that in 2016, Nike took approximately 36.6 days to collect the cash they were owed for by perhaps their consumers, right? And this number is useful because it tells you how much at any one point in time if the company is healthy in terms of its operating cash flow, whether there's enough working capital to stay afloat, etc. So the way we calculate this accounts receivable days is just a formula. You can Google this up as well. Is in almost every basic finance accounting textbook. It's just you take the accounts receivable, you divide that by revenues, and you multiply that by the number of days in a year, which is 366 for 2016. You get that, you get this, and you get the next year as well. Similarly, you do the same thing for inventories, and you do the same things for accounts payable. After you get these numbers, what is then useful is that you want to assume that whether or not you have the reason to believe accounts receivable is going to improve, or whether accounts payable is going to improve, etc. Why we took the step of bringing it to days instead of just projecting straight from accounts receivable is because we note that these things are inherently linked to revenue, right? If your revenue drops, your accounts receivable is probably going to drop as well. But that is something which may not be the case if you think that the accounts receivable days improves, for example. Which is why we want to break this down to days first, because days is a sign of efficiency, which is something which you can more easily allude to from your investment thesis as compared to just the numerical figure of accounts receivable. So how you do that is, let's just say the last year is 35, and we think that what's going to happen for Nike is that their accounts receivable are going to improve. And that's why you will get a slight drop over 5 years. Similarly, we make similar assumptions for inventory and for accounts payable days. Just note that accounts payable works in slightly the opposite way to accounts receivable. So if accounts payable days goes up, that means that your company's is improving in the sense that they now perhaps have greater market power or greater bargaining power over the lenders, that they're able to take more days to pay them back the money they owe them. After this, we then reverse engineer the previous formula we had. So the formula which we used to go from accounts receivable to accounts receivable days, we just take that formula, we flipped it to go back to calculate projected accounts receivable. And that's why here you can see this is actually going to be G200, which is your revenues for 2019, divided by your the number of days you have, multiplied by the days, the efficiency ratio. And when you do that, you will eventually get numbers for accounts receivable, for inventory, and for accounts payable as well. That's basically how we do working capital drivers. And what happens is that, again, these cells will be pulled into financial statements. If you scroll down to over here, if you see the balance sheet, if you look at inventories and you look at the cell reference, this comes from drivers G205, which is where we were previously. Similarly, accounts receivable comes from there as well. What is important to note is that, as you will notice right now, that when there are a lot of cells going everywhere, right? Like this cell has a reference from somebody's sheet, this cell has 3 other cell references, and often this is a slightly simple case, right? Because the cell references are just nearby and they're easy to look at. But if we take something like this, for example, and it's G139, which is off the screen, a useful thing to do, especially even if it goes across sheets, just to keep track of where the references are, especially when you're looking at a model which someone already built, or you're trying to build your own model and try not to get lost in it. One useful trick is to go to formulas, to look at trace precedence or trace dependence. So trace precedence are basically cells which feed into this cell you're looking at, and trace dependence are other cells which rely on the value in the cell. So trace precedence, you'll see this blue arrow comes up, which shows you that this and this eventually comes down to this. So again, this is just a basic simple Excel trick, which I think probably most of you would know, and if you didn't, that's pretty useful to know. Now, moving on to CapEx drivers. So CapEx is capital expenditure. As David or Karthik would have explained, this basically means how much the company is going to be investing in improving its stores, perhaps building new stores, etc. Now, CapEx is pretty tricky to model because no one really knows if Nike is going to start on some expansionary program in like the next 2 years to build like perhaps double their store count for any reason, right? But what we do know often is if we listen to enough investor calls, if we listen to enough excerpts and transcripts from the CEOs, if we look at their annual report and their growth plans, they do tend to broadly outline approximately how many stores they want to open where, how many stores they want to repurpose, etc. And of course, there are different types of stores as well, right? So you have the brand factory stores, the inline stores, Converse and Hurley. So what we have done for sake of simplicity, and again, this is something which you may or may not want to do when you are doing your own stock pitch models. So if I was building perhaps a model for some other company which had very drastically different types of stores, like let's say Walmart, right, with its hypermarkets versus its supermarkets versus its corner convenience stores, I would make it a point of my model to model all of them differently in terms of CapEx. But in this case, we think that almost all their growth in terms of store expenditure and creating new stores is going to come from factory stores. And that's why, if you look at this growth percentage here, it comes from drivers G180, which is, if you scroll up, exactly just your growth, which we think is going to come from North America. This is for US stores, right? So if we think that the growth in revenue is going to be exactly proportional to the growth in stores, that is an assumption we have made in this thesis, and that will probably be backed up in the investment thesis, perhaps to show that your same store sales do not improve. That means the same stores you had right now are not selling more goods, but that whenever you sold more shoes or more goods, that only came out of the fact that you opened more stores. So often it's also useful to look at same store sales, and perhaps that's another way to model a company like Nike, right? So you look at same store sales, you look at how many stores are being opened, and you multiply those two things, then you get a sense of revenue. That's more useful. So in this case, we've not done that. We've gone for the simpler approach, and we've made an assumption for any reason whatsoever we had in the investment thesis that that's the way we're going to do it. So here we again are going to assume that all these other stores are practically going to be the same, right? So your Brandline, Converse, and Hurley's are the same, while these have increased proportional exactly to US revenue because these are US stores. And here we're just going to sum all of them up. And we're going to do the same thing pretty much again for non-US stores. So we think all of them are going to be the same again. And here, you eventually come down to sums of total stores. What is important to note is that CapEx per store is a thing as well, right? So how much money exactly you spend per store building it newly. And if you look at the historical numbers, this number has been dropping. So they've been spending $1 million per store and it's slightly been coming down over the last 3 years. We think it's going to come down as well in natural linear projection of the previous 3 years. But at the same time, we think that there is still a lower limit to this. Like you can't keep on reducing how much CapEx per store you have. It's going to cap out at some rate. And that rate, based on some kind of industry research, based on looking into how much it costs to make a store, whether it's a Nike store, Adidas store, other companies and comparables, we've come up with a number of 0.80. And we think that this number is going to stay constant over the next 5 years. You can disagree with this assumption, you can test this assumption, all of that is up to you, right? That's fine. So eventually, when you just do a quick multiplication of total stores and CapEx per store, you will come down to approximately how much you think they're going to spend in CapEx. Why is capital expenditure important? It's important because that is the difference between your operating cash flow and your free cash flow. So when you go from operating cash flow, when you calculate that out of your cash flow statement, that just tells you the cash going in and out of the company. But if you want to look at free cash flow, which is much more useful for our validation methodologies, you need CapEx, and that's why we build a CapEx driver as well. Again, if we do the same thing, which the quick Excel trick, if you look at formulas, look at trace dependence, you will see this like weird black arrow with this sheet, which basically says that it came out of some other sheet. And if you click on this arrow twice, it will tell you this comes from this place, right? So I know where it is, so I'm just going to skip that, and you should over here. Note that CapEx driver is feedback in here, right? Because this is under operating cash flow, CapEx, and that is the numbers which are just pulled out of the drivers sheet. So back to drivers, and these are the last type of drivers, right? Your cost drivers, or in other words, margin drivers. So there are different ways to build cost drivers. So the one way you can look at it is perhaps a bottoms-up approach, which is you literally think of all the different types of costs a company has in terms of raw numerical numbers. So you think it's going to cost them $20 to sell this shoe, it's going to cost them $100 for store rent a month, etc. And then you add that all up and you come up with a total cost number. That's one way to do it. Second way to do it is to look at it in terms of percentage of revenue. That means you think that all the time, no matter what my revenue number is, and again, you can feel free to disagree with this assumption because it is after all an assumption. You can think that perhaps no matter what my revenue number is, rent is always going to be 0.07%, for example. And that's why we have chosen that approach. We've gone with unit inputs. How do we come up with these numbers? We look at other companies, for example. We look at Nike's own filings before, or we look at other similar stores like ASOS. And we think that these are the unit revenue margins which were used, and we think that these are pretty industry normal. And that even if these things really changed by 0.01 or 0.001, they don't make that much of a difference to our model as a whole. Of course, if you want to be more granular, you can break this down even further. So you can look at rent in different types of stores, in different regions, perhaps like your downtown stores versus your suburban stores. You look at labor in different ways. You can look at labor as outsourced labor versus domestic labor. You can further break down depreciation, amortization to different types of PPE which are being depreciated, etc. So after you make all these assumptions, you eventually come down to looking at it again in a business model sense. So when we did this earlier for revenue, on the revenue side, we looked at it as wholesale and we looked at it as direct channel. And then we also had a few of global brands, Converse, etc. Here, we think that costs similarly differ in a certain way. And that way we think is whether it's being sold through e-commerce or whether it's being sold directly in a brick and mortar store. And obviously the cost structure, the cost types are going to be different, right? That's why you see that e-commerce labor is less than store labor. We think that e-commerce depreciation is probably going to be slightly less than your store depreciation, and these are other things. And of course, the final method of selling is also wholesale, as mentioned above. So that means that e-commerce is basically just a subset of your direct sales. So direct sales breaks down further in terms of the cost side into e-commerce and direct sales, and then you still have wholesale as the other channel. So what we first do is that we need to look at e-commerce as a proportion of total revenue. How do we come up with this number? We come up with this number because if we look at total revenue earlier at E168, you would have noticed that your total revenue of direct sales are probably going to be 13.6 plus 5%. And that historical number is provided by Nike, that 5% of that 18.6% came from e-commerce and the rest came from direct sales. We need to make an assumption into the future about whether or not e-commerce is going to start taking up a greater proportion of revenue. So this is a pretty cliche and classic example that everyone thinks, e-commerce is the next big thing for companies and that this is probably going to increase, which is why we've made a similar assumption and we think that e-commerce proportion of revenue is going to increase in the future. Then, after we make this assumption, similarly, we need to look at how much your labor is going to change by, or your warehousing, etc. So once you have this assumption first, you then feed this back into the revenue figures. So G193, which was your final revenue driver here, this one. You come back down here, you just do the time 8.5% to come up to see how much of the revenue is coming from e-commerce. You get these figures. After this, you just multiply this with your store rent or your e-commerce labor to come up with your e-commerce labor figure. And that is fairly straightforward. So you just know that all of this these are all just numbers coming from this multiplied by that, this multiplied by that, etc. Down here for direct sales, you're doing broadly the same thing again. So you know that this plus this is going to equal to your total percentage of direct sales. So you just do that minus that to come up with your number again. So note that this time it will be black because it's calculated. The first one is an assumption, but this is no longer an assumption. After that, you do the same thing again. So you multiply by your total revenue figure for that year to come up with how much of the revenue is going to be coming from direct sales. And you then scroll down to do the same thing which you did above. So this is all fairly straightforward and it's starting to become slightly repetitive in the nature. And that's good, right? Because you know that your model has some sense of consistency to it. Similarly, you know that your wholesale revenue is just going to be a wholesale revenue. And you know that the wholesale unit margins as a flat figure are 0.25. And you just multiply that. And you eventually come down to your total projected overheads. Your total projected overheads are useful because they tell you what your difference between your revenue and then your gross profit is, because that difference is going to be your cost of goods sold, which if you scroll up over here, can be seen over here, right? So this is a basic financial statement. And as you scroll down, eventually you'll notice that all of it flows down. So you start off from revenues, which is the top line built in by your driver. You look at gross profit, minus of cost of goods sold. And here we're going to assume that the cost of goods sold grows proportionally as sales grow. And eventually, all of this leads down to an EBITDA, which is your earnings before earnings before interest, tax, depreciation, amortization. So a crucial thing to note is that when you build your three statements, so you have your income statement at the top, balance sheet followed by cash flow, there will be a lot of items you don't have a thesis about. And frankly, a lot of items don't even have any idea what they mean, because sometimes companies' reporting structures can be extremely complex and may not necessarily make a lot of sense. So that means that it is useful, as we mentioned earlier, to just flatline anything you do not have a thesis about. That is why you see so many red assumptions here, which are basically just a flat line of the last year's figure. And that's because we do not have any great idea on whether or not we think prepaid expenses are really going to change for Nike or not. That is one approach, to just flatline the last number of the previous year. Another approach is to look at it as taking an average, for example, of the last 3 years, and then coming up with a total number. So when you scroll down, after you've done all of this, and this is going to take you quite a while, you need to also make sure it balances, etc. When you eventually finally come up with what is important to note is that you will eventually finish this after you go through this whole process. And that's not something we're going to run through today. That was probably something which was done in more detail last week. Eventually, all of this just tells you how well this company is doing. And we have not even reached the stage of valuation, which is looking at it in terms of stock prices, looking at it in terms of methodologies and how we want to value a company. So broadly, there are two ways to value a company. The first way is to look at it in perpetual growth. So what perpetual growth means is that you think that a company is going to forever generate a certain rate of cash flows and is forever going to grow at a certain rate forever. And that is, if some of you have done like some kind of math at A-levels or in university, you would know that that is basically a series to infinity, right? And then you want to find a sum to that series to find some kind of a terminal value to see if that's the final value of the company. And that is called the Gordon growth model. It's often used more in academia than in actual equity research. Of course, it is still being used, and it's usually used as a sense check as well. And that is something you can simply Google if you want to find out more about. The other methodology to come up with a value for the stock is to have some kind of a exit multiple. What does it mean to have an exit multiple? An exit multiple, a multiple firstly, is basically just a ratio. So an example of a multiple could be EV over EBITDA. EV standing for enterprise value, EBITDA standing for earnings before your tax, your interest, depreciation, etc. So EV over EBITDA, if let's say it's 5, what that means is that if I multiplied the company's EBITDA value for a year by 5, I would get back its EV, right? And that's useful because EV is a closer link to a final stock price as compared to just an EBITDA value. So just knowing the earnings of a company do not tell you exactly how much it's going to be valued at. Similarly, another multiple you can look at is price over earnings. Price over earnings is something like where you just take the net income, you multiply that by the ratio, and you get the price, which is, in other words, the market cap. So these are all ways of looking at different multiples and different ways to value a company. And of course, it would make sense for you to use a multiple which you think best reflects the company's structure and business model. So for example, if I think this company is extremely depreciation heavy, something in the industrial sector, for example, I would definitely want to use a multiple that includes the depreciation and factors in that, rather than something that completely ignores it, like EV over sales, for example. And that's why it's useful to note that while there are many multiples out there, the choice of picking the exact multiples is something you need to give good thought to. At the same time, there's no such limitation that you can only choose one, right? You can do multiple valuation methodologies, like I'll show you later. And if you have like 5 different target prices, that's still fine. You can create a valuation football field and you can look at them as a holistic picture for where your stock is going to go. So what we have chosen to do is we have chosen to come up with comparable companies, and we've chosen to come up with some kind of a multiple for these companies. So firstly, comparables. What does it mean to have comparables? So we think comparable companies to Nike, as you would probably expect, Adidas, Lululemon, Puma, Fila, Asics, etc. These are all companies which are in the same business line as Nike, are also multinational in nature, and sell broadly the same good in terms of where it is along the value chain. And this is useful to think about because while some cases like Nike may be extremely obvious, it may not be that obvious for other companies. For example, if I was doing a pitch on, let's say, oil and gas, for example, right, a slightly complex industry, I would not want to use a player who is playing pure play petroleum for jets and then compare that to like a crude oil producer, because those are not necessarily the same exact type of company in terms of value chain. So similarly, when you do this for Nike, you get Adidas, you get all these companies. You pull this data from CapIQ or from Bloomberg, etc. This is fairly obvious on how to do that. And if you don't, you can just Google this up, or you can send an email to Oxford Alpha Fund and they'll get back to you. So when you pull these values and these multiples, we pull different multiples because we want to look at more than just one multiple at a time. We pulled price over earnings. We did EV, EBITDA, EBIT, and EV sales. It's important to note that you should preferably take your next 12 months multiple and not your LTM. So you'll have different types of multiple, LTM, NTM, trailing 12 months, TTM, etc. It's preferable to take the next 12 months because you want some kind of a future forecast in whatever you're doing, right? If not, what's the point of everything we're doing here? So you have a few approaches here. The first is you can just take a simple mean of all of these companies. You can take a simple median of all of these companies and say, okay, I think that's the industry multiple. That approach may work if the industry is very similar in terms of where the companies are trading at in terms of multiples. However, if you notice here, Nike is trading at a premium to pretty much all its competitors minus Lululemon in almost all the multiples, which means that perhaps it will not make that much sense for us to just take a simple mean and use that as a value for the EV over EBIT for the valuation, because you're probably going to be undervaluing the company. So instead, what we have also done, another option is to just, and this is a very simple thing, you just pull the projected multiple from Bloomberg for Nike in 2019, 2020, and 2021. This is a very simplistic approach, and we've done this purely for the sake of demonstration. And if you have any other way of coming up with a multiple and you think that that's a better way, we encourage you to do that, and we probably will look at that equally well. Finally, one last thing we've done here, which may not be necessary most of the time, but just for the sake of demonstration, we decided to do, is to look at it as trying to calculate your implied shares. So often, if you take your earnings per share and you have your net income of the company, you will be able to do a simple division of D54 divided by D53 to come up with your implied shares, right? Because if there's total net income and that is your total earnings per share, then you know how many shares there are. We've just done this for the sake of demonstration. You don't have to do this because often you can just take the simple shares outstanding figure of Bloomberg in the first place. So we have come up with implied shares of 1602. And all of this is now going to feed back into perhaps the most important sheet so far, besides the drivers, which is your valuation sheet. So the first thing we want to do is we want to get our net income, our EBITDA, operating cash flow, and capex onto this sheet, right? So we want to do a simple cell reference. So we just do equal to financial statements D25. If you want to know exactly on how to do that, slightly simpler, instead of just typing that, you just type equal to, go to financial statements, and you find like a cell, and you do that, right? That is fairly simple. So you do the same thing here, come down, and you pull all these values out. These values are going to be in green here because they come from a different sheet, and we just want to keep that clear because we do not want to mix up what is being calculated on this sheet versus what is coming from some other sheet. Then after that, as we said before, and basic accounting practices, operating cash flow minus your capex gives you your free cash flow. And guys, just to be clear, at any point in time, if anyone is has any questions, just feel free to type in the Q&A. Okay, so I'm just going to take it a bit slower here, right? So for free cash flow, you do your operating cash flow minus capex. That's again straightforward Excel formula. Get your total free cash flow. To look at growth, you do the same growth formula we've always been using, right? So G17 minus divided by F17 minus 1, and you put that as a percentage cell, and that should give you these figures. Now, it's very useful for us to look at different cells with a different formatting. For example, if you look at this cell, this 1000 in brackets actually means minus 1000, and I didn't have to type in the brackets. They just automatically came in because I'm using a custom format. And this custom format is something which you can include into your Excel in the first place. So if you come to custom and format cells, custom, and then you scroll down and you find this one specifically, and you can always Google this up, you'll find it on pretty much any online resource. You will find that this specific formatting is very useful when you do accounting modeling, because it tells you what are negative numbers, tells you what are positive numbers, and it also tells you, it gives you numbers in appropriate units. So these are all units I'm doing, it's all in millions, right? Which is very useful for me because I do not want to conflate things up. Similarly, if I want percentage figures, I just put it in a simple percentage thing. So the next thing is, after we've pulled all these numbers, we've come to free cash flow, we need a discounting factor, right? What is a discounting factor? A discounting factor is the idea that money today is worth different to money tomorrow, right? It's the basic concept of most of accounting. And you want to discount future cash flows because you think that cash right now is more worth it's worth more than cash in the future. So what is the discounting factor we can apply to this? So sometimes in other kinds of accounting, a discounting factor you could use is perhaps like the op cost of a certain investment. In this case, we think that a good way of looking at discounting factor for financial modeling is the idea of WACC, which is your weighted average cost of capital. What is WACC? WACC is the exact formula is broken down where you look at weight of equity multiplied by cost of equity plus weight of debt times cost of debt, and your debt is going to be multiplied by times 1 minus tax rate. This formula would probably have been explained by David earlier on, and we're just going to use this formula here, right? Because what this formula gives us eventually is the idea that every year the cash flow of that year in the future is worth this much percent less to me, and this goes in and this compounds, right? So my value of my 2023 cash to me is worth this number WACC to the power 5 less than a 2018 present payment to me right now. That is the idea of WACC. So to come up with all of these individual things within WACC takes a bit of work. So the first thing we want to look at is cost of equity. What is cost of equity? Cost of equity is the idea that if I, as an investor, chose to perhaps put my money in something else, which is risk-free, like for example, the US 10-year Treasury bonds, which is basically, if I put my money in, no matter what, I know I'm going to get back a certain amount plus a certain yield at a certain year. Or perhaps if I just put it in the broad index as a whole, like I just invested S&P 500 all the way, and I would get that much back. That is the cost which I'm incurring by instead choosing to put my money with you in your company. And that is the cost of equity. What is the cost of debt? The cost of debt is pretty intuitive, right? It's your interest rate. So if I'm taking $1 million in debt, if I have a 1% interest rate, that's going to be my cost of interest. My interest is going to be the cost of debt. Tax rate as well is fairly standard, is your corporate tax rate. So the thing is, cost of debt and tax rate are fairly simple numbers to come up with, right? But the thing is, you're not sure exactly how to come up with cost of equity. It's not a very standard, as straightforward number as the other two. And that is where we bring in the idea of the CAPM model. It stands for Capital Asset Pricing Model, which is basically one of the cornerstones of most of financial modeling. And it argues, and there are some disagreements with this, there are some other models proposed by other people. You can use any of them, or you can use a simple one, just CAPM, which is the idea that cost of equity equals to your risk-free rate plus beta times return of market minus risk-free rate. So what do these terms mean, right? So the first one we're going to look at is risk-free rate. Risk-free rate is the idea that how much money can I make off the market without incurring any risk? So if I put money into Nike, I'm incurring the risk that the Nike stock price crashes. I'm incurring risk that perhaps Nike goes bankrupt, right? That's a risk. A risk-free asset usually is considered would be your long-term treasury bonds issued by your US Fed, issued by your central banks around the world. So what is useful is you need to look at these numbers in a 10-year annual sense, right? So what does this mean is that over the last 10 years, on an average annual basis, how much would I have made risk-free per year? So you're doing your total 10 years, taking the average of that, and you're looking at it per year. That's why this number is probably wrong, because the actual number, this number is the current year's number, which is just 0.7%, right? But if you look at it and that's because right now interest rates due to COVID or any other financial economic uncertainty are at a record low. But overall, if you look at it over the 10-year frame, it's probably going to be around 3 to 4%. The next thing you need in this formula is your beta. Beta is something which you need to take a 3-year unlevered one, and you can probably take this off any Bloomberg or CapIQ, etc. Right? So we found that the beta for Nike is probably going to be 0.98. Again, it is useful for you to look at beta and try to understand what exactly it means instead of just putting the value, right? So you can pull the value, you can make the model, but in terms of an understanding basis, beta is often a measure of a stock's volatility in relation to the overall market. So this means that by definition, the market, which is the S&P 500 as a whole, the index, has a beta of 1. And then individual stocks are ranked according to how much they deviate in terms of volatility from the market, right? So a stock that swings more than the market over time has beta above 1. A company like Nike, we found as a 3-year unlevered beta of approximately 0.98. The next thing you need is return of market. So what does return of market mean? Return of market is just how much money would I have made on an annual basis if I just put money into the market as a whole. That means the index, the S&P 500. And a good approximation of the market is the S&P 500 index. There are other indexes and indices out there as well which you can use. So we found that the return of market on an average over the last 10 years has probably been around 9.75% per year. So we take these three numbers, we do the formula here, cost of equity, and you come up to find your final cost of equity number, right? Which is probably around 9.57%. Again, just to note that if this value had been slightly higher, you'll see a difference in this value as well, right? After that, we move on to the slightly more intuitive things. So cost of debt. How do you come up with cost of debt? Cost of debt is your interest rate. So we pull that from the financial statements. So if you took your interest expenses paid per year as a company, which is reported separately, and you took that and you divided that by perhaps your total debt of that year, you will know approximately roughly what is your cost of debt. Another way of doing this, which is slightly better and slightly more complicated, is to exactly analyze all the different notes and different types of loans the company takes, find all their relative amounts. That means if they took 100 million off at a certain rate, then they took another billion at like a slightly smaller rate, etc. Then you can match these things and take a weighted average to find a more accurate cost of debt. Or looking at it in terms of interest payments works as well. The next thing you can look at is tax rate. Tax rate is basically your tax expenses, then you divide that by your notepad to find your tax rate, right? That's fairly straightforward as well. And all of these things, just to note, come from your financial statements, right? So what then happens is that you now have everything for your WACC formula except your weights. So what is weight of debt and what is weight of equity? Your weight of debt means that because eventually we're looking at average cost of capital, and capital intuitively basically means something like assets, right? And when we look at it, and when we look at a company, there are probably two things they can do to finance themselves, either debt or equity. And we want to see how much percentage values both these things make up. So what we do is we pull the values for debt and equity from financial statements. So that's why we have these two things just come up from your financial statements. Then to find a ratio, you just do this plus the equity value as the denominator, and your numerator is just going to be your debt value or your equity value based on what you wanted for the thing. So one thing to note is that here we're using book values, right? And that book values are basically values that come out of your book, which is your financial statements. Another way, and a slightly better way of doing this perhaps, you can go look at is to look at it in terms of a market cap perspective for your equity. So that gives you slightly different values here, and that will affect your total weighted average cost of capital. So eventually, when you put all of these things into the formula, you'll come up with a WACC value of 5.85%. First thing to note is that you need to always be cognizant of the fact that your WACC value may be wrong, your WACC value may be too low, too high, etc. And it is useful to go and look at historical WACC values of a company, of the industry as a whole, to get a sense check of what you've done so far, and whether you think some things can be modified. So if I could go back, I'll probably modify my risk-free rate. I'll probably try to build a more structured way of looking at cost of debt and cost of equity, etc. And even your tax rate, for example, because your tax structure can be slightly more complicated than just a simple flat rate for all your earnings, right? So eventually, when you come up with a certain number here, you want to discount this for your free cash flows, right? That was the whole point of us going through this whole process of coming up with the WACC value. How you do this is you take 1 minus, so you want to show that your value is 5.85% less per year. So if you're looking at the fifth year, it's going to be 1 minus 5.85% to the power of 5. And a good way to do this formula is to just look at column numbers, right? So you take column A19 basically just means column 1. And this will go to column B19 just means column 2, column 3, column 4, column 5. Which is what we've done. And because you do not want to be hard coding this, you do not want to be writing 1 minus D40 to the power 1, then to the power 2, to the power 3. That just takes too much time. So you can do it this way, which cleaner. After you get these discount factors, you just do this free cash flow of 2019 multiplied by the discount factor of 2019 to come up with the present value of the 2019 earnings. So this number will obviously be discounted by a bigger extent. That's why you see a bigger drop. And when you come towards the end, you see much bigger drops, right? Here it's dropping by almost 2.5 billion versus the earlier years. And that's obviously because of the present value concept. So after you've done all of these things, you need to come up with a terminal value of the company. So what is a terminal value? Terminal value is the concept that eventually, perhaps in 5 years later, in 5 years down the road, Nike gets acquired by someone, or you want to look at the final value of Nike as a company, you need to come up with a terminal value. So that is all the present values, which is all the extra cash they got in until that point, and then the final value of that as a whole as well. So your terminal value can be calculated in different ways, right? So one thing I mentioned earlier was the quadrant growth model, where you can go and look at growth rates, and you can look at it as a perpetuity, which means that you assume that there'll be a growth in your free cash flows forever into the future, and eventually that will come down to a fixed sum because it's a sum to infinity of a geometric series. On the other hand, what you can do is you can look at it in a multiple perspective. So you can say that I think that the final multiple for Nike, with which it will be acquired, with which it's going to be valued, is going to be a certain number. And you think that multiple, maybe you use PE, which is what we've done here, right? So how do we come up with this terminal value? What we first need is we need all the multiples, which we calculated in our comms sheet. We do that again by just including sales reference. So we just do this comes out from comms D47. And here you'll note is 19.8x. And this is not us typing in 19.8x. This is again a custom formatting where if you look at it in a number, it's 19.8. If you look at currency, it's this. But because of the way we use the custom format for this, the x comes out, and that's useful because it tells it is a multiple. And it's slightly more cleaner, and makes the model look more professional. So similarly, we do these things for EV/EBIT, EV/EBITDA, and PE. And we know that if we want a terminal value, we want to calculate this perhaps using, and we decide to use the PE multiple. So we take K13, which is your net income, which is going to be basically earnings, right, of the last year. We take that, we multiply that by the multiple, and that gives us multiply again by the discount factor, obviously, because we want to look at the current value of what Nike's final value will be 5 years later. So you again need to multiply by the discount factor. And all of that will give us a final value of, we think, 124 billion. So this plus all your present value in terms of cash flows coming into the company as a whole give you the enterprise value of the company, right? Which is why you just do a sum, K21, which is just the cell, followed by a range, G20 to K20, which is all of these cells. And that gives you this. Now, the thing is, enterprise value is not necessarily the same as market cap, right? So what market cap means is what is the total value of all the shares of this company being traded on the stock market. And that's different from your enterprise value. How is that different? That's different by a few things. Broadly, debt, cash, minority interests, and there are a few other small things as well, right? So for the sake of this model, we have looked primarily at subtracting debt and cash. And if you build a slightly more complicated model which includes minority interests and other things, that's great as well. And that's something which we would like. So for market cap, what we have done is we take the EV, we minus off debt, and we minus off the cash. How do we get these values? From financial statements, obviously. So we want to pull these values as well, right? For EBIT, for net income, EBITDA, and current debt. So the thing is, I can do a simple equal to, and then I can go and find it on my financial statements, etc. Right? That's only going to give me the value for a particular year. That means if I go and decide to do it for 2021. But what if I want to make my model flexible? What if I want to change everything on this sheet just by changing this cell to 2020, and then that gives me the 2020 multiples and etc. A good way to do this is index match. So index match is a slightly different way of doing a VLOOKUP for some of you who are more familiar with Excel. So index match basically is a way of pulling information from a table using a certain set of horizontal and vertical criteria. So what I mean by that is, if I have a table like this, right, financial statements, if I want to get this number, 44584, or in the sake of, for this example, if I want to find net income of 2021, or let's say EBITDA, right, of 2021. If I scroll on to the EBITDA column over here, 2021 is row I, this number. If I want 8294 to appear there, I can either just do the simple equal to and then I come and click this, or I can try to find a way to make the formula search row 31 for me, match that to 2021, and then come down and find 8294. And that's what index match does. So index match, I'll just run through this formula, and you can Google this as well, right? So I'll just slightly slower if I can. We're going to look at, this formula says, look in financial statements D31, K31. So that's where the EBITDA row was on the financial statements, and match the column, if you look at that, to, so the index formula needs a few things. It needs an array, it needs a row number, and it needs a column number. So we have given the array and the row number. So what we now need is a column number, right, for you to look at. And that's where we use the match function. So match, what it does is, it looks at this cell, meaning the one I changed, right? If I have 2021 here, it looks at S7, which is 2021. It matches this value to row 2 on financial statements. And row 2 is just all the years. So it finds that 2021 in S7. It comes here, it finds that it's this number, and it takes this vertical reference as what it should look at in row 31. And that's how the formula works. So that's how I'm able to first come here, look for 2021, take this row, come down here, come to row 31, and take out 8294 as a singular cell I want. And that's how index match works. So if I do index match for all of those values which I wanted, I get the values, right? I got 8294 exactly like I wanted. So now what I do again is coming back to the main picture, which is your enterprise value, and trying to move into market cap. You want to minus off debt and you want to minus off cash, which is why I've done K22 minus S11 minus S13, which is your debt and your cash. That will give you 143. And we also wanted to just find the shares outstanding, which is something we calculated from the comms section over here, right? 1540 for 2021. And we divide that again to find your implied share price. And we think that it's probably going to be 92.89. Back then, I think Nike was trading at around $73 to $75. And that is what a free cash flow waterfall, that's another name given to this whole table we've done here, will predict as the share price. Of course, we want to sense check this with other methods, right? So the first method we thought of was multiples, and there are different multiples here. So if I use the PE multiple only, that means I didn't do these free cash flows, I looked at it only as a PE perspective, I will find the market cap as this number times your S16. S16 is this, versus times your S8, which is your net income over here. That's how I get my market cap. Note here that I went straight to market cap instead of going to EV first, because in the PE multiple, P stands for the market cap, in this sense, for all the shares. Then I divide that by the total number of shares, I come to your implied share price. Same thing I do for EV to EV over EBITDA. So here, what I do is I take the multiple, I multiply it by EBITDA, which is in S9, and then I get my EV. After that, I eventually come down to market cap. Similarly, I do the same thing, right? So I have to minus off cash, I have to minus off debt, and I divide that by the number of shares, and I get an implied share price. If I do the same thing for EV EBIT, I get a different share price as well. And the first thing to note is that, and it may be slightly alarming to you, like, why is it that if I use different methodologies, I get 79, I get 75, I get 86, and I get 92 there, and these are all grossly different numbers? The reason for this is that, firstly, different multiples are applicable differently to Nike. So some multiples may be more accurate, some multiples may be less accurate, and that's up to your own personal discretion to figure out which multiple is the best for Nike, or whether you think that the waterfall was the best method. So let's say that we have chosen to do EV over EBITDA, and I think that that's the most reflective. We just pull this value back here, we get 75.25, and to calculate the upside, you just take this minus this, minus 1. This D5 over D6 minus 1, and that tells you that approximately your upside is going to be 3.1%. And that is how we come up with the final share price of Nike using EV over EBITDA valuation methodology. Of course, to make this model more complicated, if you had more time and if you thought of finding ways to test some of your assumptions, you could build sensitivity analysis. So what sensitivity analysis does is that it says, if these assumptions were different, how much would my share price change by? Or if my WACC number is wrong and I think it should be 8%, how much my value change by? And you can build a table for that. I'll not go through that today for the sake of time, but a useful resource to look at is to look at what if data validation tables on Google, and to find any simple corporate finance walkthrough, which teaches you how to do a sensitivity analysis as well for your share price. But in terms of the basics, this is probably how we come up with a final share price. So now that's pretty much the end of the content we had. So now we're going to go through some of the questions here. The first thing we want to look at is, how do we get the assumptions for revenue growth? So in terms of revenue growth, these numbers right now may seem slightly wrong because we do not have an investment thesis behind this model, right? You're not seeing the investment thesis, you're only seeing the model. But if you had an investment thesis, some of the ways you could come up with a volume growth number is to look at it in, to look at why you think they're going to do better in China. So you can look at it historically. You can look at perhaps China's middle income, or you can look at the higher income, high net worth individuals, how much they're growing by, how much of them are saying that they want to buy Nike, for example. And these are all things which help influence you come up with a final number for volume growth. At the same time, you can, again, as I mentioned earlier, you can test these assumptions, right? So you can say that, what if I change this number to just 10%? If I change this to 10% here, my whole model should change accordingly, and my whole sensitivity analysis will show that my stock price is going to change as well. And in terms of other things, just crucial things to note as a whole is that at the end of the day, the model is just, as it suggests in the name, just a tool for us to interpret how different things change, different things in the real world. And at the end of the day, what you should give much more focus to is your drivers, is to understand why is it that the company is behaving such a way. So for example, if you struggle with the financial statements and balancing up everything to make sure that your cash from your cash balance in your balance sheet matches your cash flow statements, change in cash, etc., and you think that your model doesn't balance, that's still fine. Like it's fine if your model doesn't balance at the start. But what's more important for us and what we're looking for in a stock pitch or as an analyst is the way you come up with these assumptions in the first place. Because once you build this the first time, right, changing these numbers pretty much does all the work for you. But what is more important is the kind of thought process you had in why should I split it up by region? Why these regions? why did I choose to split up by wholesale versus direct sale? Why did I look into markup? Why did I think that this number is going to be 10% and not 50, for example? And I think those are much more useful skills, which are much more fundamental and much more qualitative in nature, which you need to um, tease out by doing a lot of reading about a company, by looking at a lot of sell-side reports, etc. So other things you can do in your model as well, just to build on, is perhaps look at how much your prediction compares to sell-side predictions. So if sell-side already thinks that it's going to hit 75.25, and perhaps you've done the EV over EBIT model and you got it 86, it's useful for us to sense check, why is it that I disagree with sell-side? And it's fine. It's not that you have to agree with them all the time. It's fine to disagree because they are wrong pretty much all the time, right? But the thing is that you need to have a strong reason for that, and that's why whenever you build a model, it's useful for you to comment out why I thought this number was this, so that anyone who's reviewing your model can understand that better. So that brings us to the end of this session on modeling and